In the world of heavy industry, there is a specific shade of yellow that signifies more than just a brand. It represents a literal reshaping of the Earth's crust. In 1925, a high-stakes merger between the Holt Manufacturing Company and the CL. Best Tractor Company birthed an entity that would go on to build the Hoover Dam, the Golden Gate Bridge, and the interstate highway system. This was not a merger convenience, but a marriage of survival between the pioneer of the continuous track and the master of the undercarriage. Today, this company is a $67 billion industrial leviathan that serves as a heartbeat of global infrastructure. As we begin our forensic deconstruction of Caterpillar, I want you to focus on one specific number. For million, this is the mystery number that separates Caterpillar from its peers and acts as the ultimate predictor of its future cash flows. Hold that figure in your mind as we peel back the layers of this heavy metal fortress. The evolution of Caterpillar is a story of outmaneuvering early rivals through a ruthless commitment to product support and dealer networks. While competitors like International Harvester and Alice Chalmers focus on the initial sale, Caterpillar's founders realized that a machine is only as valuable as its uptime. They built a localized dealer network that became a secondary moat, ensuring that a broken part in the middle of the Australian outback could be replaced in 24 hours. This strategic pivot transformed them from a mere equipment manufacturer into a mission-critical service provider. Throughout the 20th century, through world wars and massive infrastructure booms, Caterpillar didn't just build machines. It built a standard that effectively locked out foreign competition for decades. By the time Komatsu and Hitachi emerged as global threats, Caterpillar's vertical integration and dealer loyalty had already created a network effect that made their yellow iron the default choice for the world's largest construction firms. To understand the operational engine of Caterpillar, we must dissect its three primary revenue pillars. The first and most iconic is construction industries, which generated $27.3 billion in 2023, representing 40% of total group revenue. This segment is the primary driver of the company's cyclical volatility, deeply tied to global housing starts and government infrastructure spending. The second pillar is resource industries, contributing $13.2 billion, or 20% of revenue. This is the mining powerhouse, producing the massive 79 7-haul trucks that move mountains of ore. While this segment is smaller, its margins are often bolstered by the sheer scale of the equipment. The third and perhaps most vital pillar is energy and transportation, which brought in $27.6 billion, accounting for another 40% of the total. This segment provides the reciprocating engines and turbines that power data centers, ships, and oil rigs, providing a crucial hedge against slowdowns in physical construction. Geographically, Caterpillar is a true global arbiter of economic activity. North America remains a dominant stronghold, providing $33.9 billion, or 50% of total revenue. This region has benefited immensely from recent legislation like the Infrastructure Investment and Jobs Act. The EME region, covering Europe, the Middle East, and Africa, contributes $13.1 billion, representing 20% of revenue. Asia-Pacific follows closely with $12.2 billion, or 18%, though this region has faced headwinds due to the cooling Chinese property market. Finally, Latin America accounts for $7.8 billion, or 12% of the total pie. When we compare this to Komatsu, which has a much higher concentration in Asia, or John Deere, which is more heavily weighted toward North American agriculture, Caterpillar emerges as the most geographically balanced industrial conglomerate in the world, capable of shifting its focus wherever the global building cycle is hottest. The forensic deep dive begins with a look at the company's capital structure and efficiency. Caterpillar operates with a level of financial sophistication that mimics a bank as much as a manufacturer. Their total debt levels sit at approximately $38 billion, but a significant portion of this is tied to Caterpillar Financial, which acts as a captive lending arm for their customers. When we strip that away, the industrial net debt to EBITDA ratio stands at a conservative 1.2 times. Their interest coverage ratio is an impressive 18 times, ensuring they can service their obligations even if interest rates remain elevated for an extended period. The operating margins have seen a significant expansion, reaching 20.5% in the most recent fiscal year. This is a dramatic improvement over the 10 to 12% margin seen a decade ago, reflecting a shift toward high-margin aftermarket services and parts, which now represent nearly 40% of their total sales. When we analyze the long-term growth metrics, the forensic data tells a story of cyclical resilience. Over the last 5 years, Caterpillar has grown its revenue at a compound annual growth rate of 4.4%. Expanding the lens to 10 years, the revenue compound annual growth rate is a more modest 2%, highlighting the brutal downturns in mining and energy between 2014 and 2016. Looking back 25 years, a period that includes the Great Financial Crisis and the rise of China, the company has maintained a revenue compound annual growth rate of 4.7%. The free cash flow performance is where the quality of the management shines through. The 5-year free cash flow compound annual growth rate is a staggering 13.5%, while the 10-year rate is 8.2% and the 25-year rate is 6.9%. This indicates that Caterpillar is getting much better at converting its yellow iron into liquid capital, primarily by leveraging its connected asset data to predict maintenance before failures occur. For the dividend growth investor, Caterpillar is the definition of an industrial fortress. The company has paid a dividend every year since 1925 and has increased it for 30 consecutive years, making it a proud member of the dividend aristocrats. The current absolute payout is $5.24 per share annually. When measured against the free cash flow, the payout ratio is a very safe 32%, leaving massive room for further increases even in a recession. The current dividend yield sits at approximately 1.6%, which may seem low to income seekers, but represent a powerhouse of growth for those focused on total return. The 5-year dividend compound annual growth rate is 8.1%, the 10-year rate is 7.9%, and the 25-year rate is 10.1%. This consistency is far superior to competitors like Komatsu, which has a more volatile payout policy, or Volvo, which often relies on special dividends rather than steady increases. In addition to dividends, Caterpillar is a master of the share buyback. Over the past 5 years, their buyback yield has averaged 3.1%, and over the 10-year period, it has been 2.4%. This aggressive reduction in share count has allowed earnings per share to grow significantly faster than net income, a key driver of the stock's outperformance. However, the path forward is not without significant risks. The company is currently facing the challenge of the energy transition. While mining for battery minerals like lithium and copper is a tailwind for their resource industry segment, the shift away from internal combustion engines threatens their traditional engine business. Geopolitically, the company is also at the center of the trade tensions between the United States and China. Much like they survived the stagflation of the 1970s and the collapse of the Soviet bloc, management is now pivoting toward autonomous hauling and hydrogen power to ensure they remain relevant in a decarbonizing world. Their forward guidance for the next 1 to 3 years suggests mid-single-digit revenue growth and continued margin expansion as they cross the threshold into a more service-heavy model. Now, we return to the mystery number we established at the beginning. For million, that number represents the total population of active, connected Caterpillar machines currently in the field. This is the secret to their forensic health. Every one of those 4 million machines is a recurring revenue engine that generates a high-margin stream of parts and service sales for the next 20 to 30 years. Caterpillar no longer just sells a tractor. They sell a 30-year annuity. This is the razor and blade model applied to 40-ton excavators. It creates a floor for their cash flows that simply did not exist in previous cycles. It is the reason their free cash flow margins have stabilized at 15%. And it is the reason why they can afford to return billions to shareholders every single year without compromising their research and development budget. For the cash verdict, we must look at the valuation through a cold, forensic lens. Caterpillar is a cyclical compounder that is currently trading near the top of its historical range. Based on a current free cash flow to enterprise value yield of approximately 5.5%, the stock is approaching fair value, but does not yet offer a deep margin of safety. For the disciplined dividend growth investor, the ideal entry price range sits between $285 and $305. At these levels, the forward dividend yield crosses the 2% threshold and the free cash flow yield approaches 7%, which has historically been the buy signal for this name. On the weekly technical chart, The stock is currently trading well above its 200-week moving average, suggesting a period of consolidation may be ahead. Waiting for a reversion to that mean has historically been the most profitable strategy for entering this industrial giant. Caterpillar is not just a bet on construction. It is a bet on the continued urbanization of the planet, managed with the financial discipline of a modern tech firm. Thank you for listening to this archive. I am Cash, and this was CASJ Global Dividend Intelligence. Stop guessing. Start knowing.